My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey, welcome back, folks. Today, zooming in from beautiful Las Vegas, Nevada, we've got a very, very accomplished real estate entrepreneur, capital raiser, real estate guy all around, Dennis Cisterna from Sentinel Net Lease. And Dennis has done a lot in the real estate space. And as you can tell from the name, these days they're focusing a lot on commercial properties with net leases. And Dennis has done some pretty amazing things when it comes to setting up platforms, bringing on investors, and raising capital. So I think that's what we'll be diving into here today. So Dennis, welcome to the show. Great to have you.
Thanks for having me, Dave. Appreciate it.
Hey, so give us a 30,000 foot big picture snapshot of what your real estate investing business looks like as of mid 2024. What do you guys do at Sentinel Net Lease?
Yeah, our focal point is really on industrial, office, and retail properties in the U.S. And I'm a value-oriented buyer. So we're buying stabilized properties that have long-term leases with high-quality tenants. And we're trying to buy those at prices that we think are outside of the normal market pricing. In the middle market, this $10 to $30 million sector where we buy most of our assets. We don't compete against 1031 investors. We don't really compete against institutionals that often. And because of that, there's not a lot of consistency to the pricing. It's not commoditized the way as buying a Starbucks or a Walgreens is. And because of that, if you hunt and peck hard enough, you're going to find value out there. And so we're a very needle in a haystack type of buyer where I'm not going to go take a building from 20% occupied to 100%. I'm not going to retrofit the outside. I'm going to make money the day I buy it because I bought it at the right price. And so that's where we create value for our investors. Very
cool, Dennis. Let's unwrap that a little bit, then we'll jump into the capital raising side of things. So it sounds like you're looking for really good properties that have really good tenants already and pretty darn good markets, but somehow when you say they're needle in the haystack type thing, so why isn't there more competition for these kind of properties? Is it because you're kind of going into a little bit smaller markets, secondary type markets? Why aren't the big guys in there causing a lot more competition?
Well, they've owned a lot of these assets in the past. So part of it is just to take a look at the competition. Institutions get bigger and bigger, right? So a $500 million fund used to be a mega fund. Now it's a drop in the bucket compared to the multi-billion-dollar funds that a lot of private equity firms and other institutional investors are creating. Mm-hmm. Because of that, they've got to deploy capital in a much more meaningful way. So while a $30 million deal used to be, normal for the institutions, now they are looking for 50, 75, 100, $1 billion deal, if not more, right? So that market has expanded so much in their ability to raise big chunks of capital quickly. They tend not to waste their time as much in the middle market. So a little bit less competition there. And then in terms of what we buy, I'm going to say a word here that a lot of people maybe aren't familiar with. It's called office. And so not a lot of people are buying office right now. So what I can tell you is not all office is good. Everybody knows that, but not all office is bad either.
And not everybody knows that. That's the trick, right?
A lot of people don't know that. And it is the conventional wisdom. It's that headline stress disorder that you get from hearing that half of Manhattan is vacant and half of San Francisco is in tatters and things are being sold at 98% off of their peak value. That is happening in empty buildings in these areas. But, in between San Francisco and New York, there's the rest of the United States to deal with, and not everybody is quite struggling quite as bad. And so we are looking for corporate headquarters and mission critical real estate that we think has value there. But because office is not looked upon as fondly, and a lot of these Midwestern markets or flyover states are not looked upon as fondly, there's just less competition. And then when you factor in this high interest rate environment we've been in for the last couple of years, it's taken a lot of my competitors to the sidelines because they're dealing with their legacy issues on their portfolio, or they don't know how to access capital in this environment because a lot of folks are gun shy to put more money in after maybe getting burned on one of these multifamily syndications that went sideways because there wasn't an interest rate cap or who knows what, right? So it's just a lot less competition right now. It's not going to be that way forever, and that's why we started a fund, because we think we have a 18 to 36 month window to gobble up a bunch of these properties at historically high cap rates.
Very, very cool. So Dennis, maybe just give us an idea of what kind of tenants do you have in these properties? If you can share, like, what are some examples of some of the kind of properties you guys have in the portfolio?
Yeah, a lot of household names. JP Morgan, United Healthcare, AT&T, T-Mobile, Tesla, BJ's Warehouse Club, if you know that, if you're from the East Coast of the United States. A lot of Fortune 500 companies. And some companies that are not Fortune 500, but are still very financially strong. So we own the headquarters of a large engineering firm, GBA. We own Jacobs Engineering regional headquarters. We have Schnucks, which is a Midwestern grocery store chain that unless you're from St. Louis, you probably have never heard of them, but they have 120 stores and do $3 billion plus a year in business. And it's a great Midwestern brand. And there's smaller companies. We own a headquarters of a company called Juice Plus, and they're a nutrition supplement company. They do about $400 million a year. And we just did a sale leaseback on their headquarters. So as long as we understand the company and what they're about and their financials, there is no right or wrong tenant. It's really just understanding the importance of that real estate, not only to the tenant, but also to the greater area. How does it kind of fit in that market?
All right. So let me just recap what I understood, and then you can correct me if I'm out to lunch. So basically, you're going after properties that are pretty big, but a little bit too small for the real big guys nowadays. It might have been sexy 10 years ago, but now these guys have just grown so much. They aren't paying too much to these kind of attention to these kind of properties in these areas. Plus, it's not as quote unquote, air quote, sexy as some other asset classes because it's got that infamous office in there, which so many people are scared of, that whole idea. So it's a combination of less competition from the big guy, the asset class itself, and the location being in a lot of that in the Midwest. Am I getting the gist of things here? And then even so, you're really, really fussy about the kind of properties that you're buying. You're still looking for that needle in a haystack kind of thing.
We have underwritten, this is no joke, we've underwritten 13,000 different buildings in the 5 years we've been in existence, and we bought 20 of them.
Oh man.
It's a big haystack. It's a big haystack, Dave.
Yeah.
And not enough needles.
There's enough needles. It makes it worthwhile. Okay, well, let's switch gears. Let's talk a little bit about the money side of things, Dennis, because, looking at the information you sent me ahead of time, you guys have been doing really well with raising capital for this kind of non-sexy asset class. I think you've got like over 350 investors that you've brought on board over the years. So yeah, tell us a little bit about what your secret sauce is when it comes to what to do and what not to do to attract investors.
Yeah, well, I can tell you, number one is be as transparent as possible. I think that is a lot of my advice is going to seem very simple, yet I could point you to hundreds of people that don't do this.
That whole common sense thing, isn't it? Yeah,
I tell you, it's it's underrated. But being transparent is totally. I think that's a huge part of it. I think it's being.
So what does that actually mean to you? What do you mean be transparent?
Show them what's behind the kimono. If you have projections on how your project is going to make money, whether it's a development deal or buying a stabilized asset, let your investors look under the hood. Let them look at a sample of your pro forma. Let them understand your true assumptions and what exactly has to happen for you to hit those numbers. One thing that I've encouraged other operators to do that I don't think they do enough of is show me what percentage of the overall profit comes from in-place income, how much of it comes from income appreciation over time, right? Whether it's multifamily rents going up or rents contractually going up with a grocery store and office building. And then how much of that comes from speculation, things that are out of your control.
SWAG, scientific wild ass guess.
Yes, right. I think I'm going to sell this at a 4.5 cap, despite nothing being sold in that number in the last 4 years or whatever, right? And so that is where I think a lot of operators get into trouble, is too much of that profitability comes from that wild ass guess, and not enough of it comes from, well, what if that doesn't happen? And so when we underwrite these deals, we assume that the market isn't going to change dramatically from now to when we sell it, because I don't know when we're going to sell the asset. And if you have somebody that knows when they're going to sell the asset at a certain price, I would look a little bit more closely if I were you about that person, because those kind of guarantees shouldn't be made by any reasonable person. There's just too many variables outside of our control. So you just want to have enough sense of reality in terms of what's going on. And so when we're buying deals, close to 40% of the overall profitability comes from just the contractual in-place income. Another 20 to 25% of it comes from the rent appreciation over time. And that means, yes, I bought it at an 8% cap today, but if I sell it at an 8% cap in 5 years, my rent's going to be 25% higher. So I'm going to have additional gains there, right? And then the last part will be, the last 20 to 25% will be assuming maybe something is going to occur. I'm going to get a lease extension, or I'm going to do this to create some additional value. And any smart operator should say, this is plan A, this is the best case, and here's plan B, and here's plan C, or even plan D, just so you know the range. That's one thing that we've done since the beginning, is we have this sensitivity analysis that says, here's a 300 basis point swing in where this deal might exit at, because we don't know. But we're going to be in the middle of that. Here's the brackets on each side, and we should be somewhere in that realm of possibility based on historical averages.
Very, very cool. So it's not so much even under promise and over deliver. It's basically show them all of the options, kind of from worst case to best case, and say we're open to land somewhere in the middle.
Look, I think the under promising is great. I think your baseline should be more conservative than what you really think it is. But I definitely strongly encourage people to show those alternative scenarios, just so people have an idea of what the range could be, especially if you're in something that's more speculative, like a value add project or development, because you really are, you have to do some financial gymnastics and stick the landing to get to that IRR, especially in today's market.
Yeah, fair enough. All right. So transparency is a big tip for what to do to attract investors. Being what not to do. Okay.
Yeah, communication is the second part of that.
Okay, yeah. So how do you guys do that with your investor base?
Yeah, so I think the benefit guys like you and I have, Dave, is this advent of technology in real estate and investing. It's all trickled down, right? So some of these products that were built for the largest institutional investment managers, well, once they run out of those guys, they have to sell it to somebody else, right? And it all comes downhill. And so we have there's just an incredible amount of tools that we're able to utilize to not only become better investment managers, better asset managers, but also better communicators with our investors. And so there's all these great investment platforms out there that allow us to give total transparency and accessibility to our investors. When I first started, this is a little embarrassing. When I first started my first platform 6 months ago, my very first distribution handwritten checks I sent out in the mail. I didn't have that technology solution. I just had good real estate. You fast forward a year from there. Now I've got an online investment management portal. All of my investors can download their monthly statements whenever they want. Okay,
Nice.
now we've made some progress.
Mhm.
Now we're at the point where not only can they download their monthly statements, get all their tax docs online, they get quarterly newsletters from us. They literally get text notifications if there's an event that's occurring on any particular asset. So, hey, just want to let you know we signed a new tenant, or we got an extension, or we've decided to sell this asset. I don't want to risk anything that I'm in someone's spam folder. And so now we've got this level of communication where if I have an investor comes to me and he's saying, hey, what's going on with such and such? I know he didn't open his email or open his text message, because we have gone out of our way to make sure that they know critical information the moment we do. And I think that just goes a long ways towards endearing that trust, to show you have that level of commitment and responsibility to your investors, because you guys are partners. Even if you're general partner and limited partner, you're still partners, and that information sharing is critical.
Plus, it simplifies the heck out of your world, right? I mean,
Oh,
on the
yeah.
back end side of things, I mean, really, it's all there all the time kind of thing. So once the investors, and I'm sure it's probably challenging with the older, more entrenched type folks that are not super tech friendly. Maybe that might be a little bit more challenging. They might need the occasional phone call and that sort of thing, but the vast majority, you get them trained up, and it's a win-win for everybody.
Yeah, that's right. And obviously that's still there. Any good operator or syndicator is going to be able, you're going to be able to get a hold of someone on their management team to talk through it, same as ours.
Mhm.
But to your point, if I can push that message out to 300 investors at once, I'm only getting 3 phone calls, not 300.
Yeah, way better. Way
Right.
better. Okay, good. So we got open the kimono. I like that. We got the better communication. What else have you found over the years, Dennis? It just really helps with uh, attracting or dealing with your existing investors.
You have to do a very good job of explaining how you're creating value and how the deal makes sense in today's environment, right? And
Mm.
that can be as simple as saying, um, it's a big macro bet. We're short on housing in the US. I'm buying apartments. Okay. There's a lot of people that are doing that. So then you have to get a little more granular. Well, what are you doing to be a little different or a little better? Are you just one of 1,000 groups out there buying apartments? Or do you have systems in place that allow you to compete more effectively? Are you going to be able to raise rents because you have a best in class property management tool? Can you handle your renovation schedule better because you have standard modules for how you increase the improve the units over time?
Mhm.
I think without giving away a little bit of what makes you different, it's very hard to gain that trust from a new investor. And then I think on top of that, you've got to show why your deal makes sense in today's market. What has been terrifying to me over the last 24 months is the number of deals I've seen where syndicators are trying to acquire assets and they're using negative leverage, right? They're buying something at a 5% cap rate and they're borrowing at 7.5%. And it's not a construction loan where like that interest rate is short
Temporary.
term. We're talking about long-term fixed rate debt that is not accretive to the transaction. And again, they're looking at, well, as long as the market does this and this and this and this, I'm going to be at an 18% IRR. Okay, and if it doesn't, you're going to make more money in your high yield savings account than speculating it on this bet. And that is I will go back. I will go till I'm blue in the face on this topic. But the deal should make money on its own the day you buy it. And if the market can outperform your assumptions, great. But at least your baseline is a good risk adjusted return relative to the other opportunities in the market. And I
Mhm.
think that's where a lot of real estate guys, they get tunnel vision and they think they're the only place where people are putting their money because maybe
Yeah.
that's what they're doing. But you've got a stock market, notwithstanding a little bit of the volatility that's been going lately. it's been rock solid for several years, right? You've got a high yield savings environment where you could literally keep your money in your bank and earn 5% per year.
Yeah.
And you just have just a ton of different fixed income and alternatives that are out there outside of real estate, that if you're going to convince someone to go into real estate, you better have a pretty compelling opportunity without an overwhelming amount of risk today.
Yeah, very, very well said, Dennis. Well, as we're wrapping up, one question I do have for you around investors is, you've got a ton of experience working with these folks. What tips would you have, or what's been your experience working with several hundred investors at this point, about how sophisticated your communication can be versus keep it super simple, stupid? Like, because a big mistake I see with a lot of syndicators is that they assume that their investors are real estate nerds like the rest of us and understand all the jargon. And my experience has been nothing could be further from the truth. But I'd really love your insights on this. Like, it drives me nuts.
I think you nailed it, right? I think you absolutely nailed it. Um, and I think this is a problem for a lot of industries when they're talking to people trying to raise money well outside of real estate. And obviously, it gets even more convoluted when you're talking about things that are more complex in real estate.
Yeah,
But
like
yes,
triple net leases, and assuming everybody understands what that means, on
yeah,
top
yeah,
of
exactly.
IRRs,
Oh,
NOIs, cap rates, all that stuff, right?
I will tell you a great story. Here's how
Yeah.
I know the average person doesn't know what a net lease is, because we put a banner up at an event, and someone came up to me and they said, "So you guys are into you guys like lease jets?" And I said, "What?" He's like, net lease, right? You guys are the. I'm like, "Are you thinking of net jets?" He's like, "Are you guys not like a similar competitor?" I'm like, "We have nothing to do with that, sir." But I was like, "Oh, okay." You are absolutely right. I think at it, a smart investment manager is going to do is he's going to lay it out as simply as possible, and then give the investor more if they want more.
Yeah.
And so I am not going to go send a 17 tab financial model to a dentist
Yeah.
who is just trying to diversify his investment portfolio, because he wouldn't even know where to start. Now, we have some guys that invest with us that are employees of big hedge funds, and they like what we do. And those guys, they're
They love
geeks,
it.
right? They're like, "This is great. I love how you did this." And we don't discriminate. You can be a property nerd. You don't have to be a property nerd, but I
Yeah.
think you do really want to communicate at that, kind of eighth grade level of, this is what your return is going to be over time. This is what we're starting at. These are our assumptions. And if you want a little more, we'll talk you through it. And
Here's the 18 taps.
that's right. That's right. They're available for you. And we have levels of that too, because right, it starts with, we'll send out an investment summary that's 20 pages, and it contains a ton of information, but very simply conveyed. And then I'll do a webinar on top of that, where I'll go into more details. I'll let the investors ask some questions, and then we'll go full open kimono to the quasi-institutionally trained guys who want to know everything. And that's available too. And I think that is really important as a way to attract a diverse group of investors, is make sure you have very simple offering up front, but also have that the complexity behind it if somebody needs it.
So I'm not going to ask you to be exact on this, but what's your best guess out of the 300 plus investors you've got? What percentage fall into each category? So the keep it super simple category versus the real estate nerd hedge fund guys that want the full kimono. Like, what would you guesstimate?
60% at least are the keep it super simple. There are investors also who have invested with us that just we've known for a long time, and they don't even remember what they invest in. I mean, sometimes it's that
They're
full
investing
of,
in Dennis. That's who they're investing in,
well,
really.
or my partner Fred, or
Yeah,
just our
you guys.
thesis. But
Yeah.
yes, but yeah, at least 60%, maybe even 70%. And then there's kind of a tapering down where they care a little more, and it gets smaller and smaller.
Yeah.
And now that we've launched our fund a few months ago, we have over 400 investors in total. I would tell you there is not more than 15 guys that really get into the weeds with me on deals.
Yeah. Yeah. No, that's kind of what I was thinking probably would be.
Yeah.
Awesome, Dennis. Well, this has been great. Thank you very much for your insights. There's been a lot of fun. I really appreciate you sharing, sharing what you guys do and your experience working with investors. If people want to connect and find out more, where should they go?
Best place to go is to the website for our fund. It's called sentinelopfund.com. That's SENTINEL OPP They can download our fund summary from that website, and our team will get in touch with them to learn more.
Awesome. Well, thank you very much.
Thanks, Dave. Appreciate it.
All right, everybody, take care, and we will see you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.